You're an all-star, get your game on, go play. Hey now, you're a rock star, get the show on.
We are back at the Big Money Big Daddy Show, bringing it to you live this Thursday afternoon in Houston. This is Dale Pieper and Mark Conley talking about the young working professional, maybe millennial, depending on when you were born. But just covering a lot of good information today. If you're just joining us, what have you missed? You missed
lot.
Yeah. But just kind of give a quick recap. We've talked about, things you need to be doing before you even get into all the, where everybody wants to get, investing money. That's what most of the time you hear us talking about on the show. But, we talked a lot of times the young professional has a lot of student loan debt, or they might be buying a mortgage, or they might have credit card debt or buying a first car. So we talked a whole bunch about debt and what's the right way to figure out, should I refinance that? And if I'm not going to refinance it, should I consolidate it? And if I do that, what's the most efficient way to pay down my student loans, my credit card debt, any type of debt that you may have? So we talked about debts. We talked about mortgages, different types of mortgages. We talked about insurance on your car and on your home. So we've covered quite a bit, just, little things. We ended the last segment just talking about little things you should be doing as far as looking at your auto insurance, making sure that you've looked at it. If you're 22, 23, 25 years old, is it the same insurance you had when you were 16? You probably need to look at that and make sure that that's been adjusted for where you're at in life now, because a lot of times you had state minimums.
I've even seen a lot of people that are 40 years old
Yes.
and they've still got $250, $500 deductibles with, 10 to 100 grand sitting in the bank. It's like, raise the deductibles, self-insure a little bit,
It's crazy. So that will save you money. And then the other big thing we talked about was just the organization that we bring to the table. Make sure you know where everything's at, that, the different things that you may have put into place up to this point. How do those things all function if you brought them all together? So that's the importance of making sure that you've got some type of website that brings all your financial institutions and insurance items that you may have, whether that's stuff you've purchased individually or just stuff that's offered through your corporation that you work at, that it's all in one place and you know exactly what you're doing and why you're doing it.
Yeah, and just to recap on what we covered on student loans, because we're getting a lot of emails and questions on that, there's really three main things that you're looking at. You can either keep them as they are, or you can go out and do a refinance on those. And we know a lot of the different banks that do that, who have the best deals, and we can help coordinate everything for you in regards to that. And if you refi, though, you might lose some of the benefits that you're getting with government loans. So you need to be aware of that and look through to see if it makes sense, because there's also number 3, or item C, whatever we want to call it, is looking at some of the debt forgiveness programs that are out there. A lot of times, depending on where you go work, you might be able to have your debt actually forgiven in a 10 to a 20-year time frame. And so those are some of the things that we work on with our young professionals, to make sure that they know exactly when they're going to be debt-free, to make sure that they know exactly how much they should, be putting towards their debts. The first thing I always say, especially when we're talking to these young professionals, you need to save 20% of your income. Like, out of everything that I ever talk about, you need to get in your mind that you need to save 20% of your income. And a lot of times they hear that and they're like, well, hold on a second, I'm buying a house and I need a car. And I get that. And I get that you're not right now. Most are not. But that needs to be in your head, that's the goal. The next raise goes straight to savings until you get to doing 20%. And really, sometimes early on, that 20% of savings is just going towards paying off debts.
Right.
Fine, it's still 20% of your gross. No, I'm not talking about your net. Yes, it is worse than you thought, okay? But it's of your gross. That's what you need to be deploying to your financial plan in one way, shape, or another. It might be part 401k. It might be part you set up an investment account. It might be part you're paying down debt. But you got to do 20%.
Yep. And if you're not, then you'll be the 45-year-old that we're talking to, and they're not saving 20% of their income.
Right. It's the biggest thing you can do, because if you establish that, especially early on, you actually get used to it. And those are the people that have that put themselves in position to, be financially independent at a younger age, to start their own companies, to be free, to just have more options. And so I can't stress that is so important, because even if you hire a terrible financial advisor, they get you a terrible rate of return. If you save enough money, you'll be okay. Now, granted, if you hire a good financial advisor who knows about efficient markets and knows about the math and science of properly investing, that's what we do, by the way, at Wealth Design Group, well, then you've got the best of both worlds. You're saving the right amount of money. I mean, too many times people think, if I just get a better rate of return, then that'll make up for the fact I'm only saving 5% of my income. Well, if you actually had a financial plan, because most people saying that don't have a financial plan, you'd run those numbers and you'd actually find out that your investment rate of return is going to have to be like 15 to 20% per year, every year for the rest of your life. And that ain't happening, okay? It just isn't happening, so forget it's going to happen. But you also, if you're going to save 20%, you need to know how to deploy it. And that's what a good financial advisor does. You need to know if you're putting your money with the right people. And that's why for our coaching session coming up October 20th, we're doing it at Papados, 6:30 in the evening. This is going to be it's going to be a little spooky since it's Halloween, but it's the topic's going to be, is your money manager a sociopath? And what does that mean? Well, it means we're going to dive into how money gets mishandled, which at the end of the day means you get significantly lower returns. How money actually gets stolen, which that's a really bad return.
It's a really bad advisor too.
And most advisors don't want to talk about this stuff because they're scared to have these types of conversations. But I mean, we watch the news, we see the stories. This is real, and people are getting ripped off. People are hiring money managers that, in our opinion, do no more than gamble and speculate with their money. And you need to know what to be looking for to make sure it doesn't happen to you again or ever, whatever it has. Some people that's happened to, and then they're scared of doing anything with their money. Well, you can't do that either. There are tried and true ways to give yourself the best insurance possible that you're dealing with the right money managers. And that's what we're going to talk about at Papados on October 20th. If that is of interest to you, all you have to do to get the information on that coaching event, as well as all of our upcoming coaching events, is just text the keyword daddy to 72727. Text daddy to 72727, or call us 713-826-0426, 713-826-0426. You also can email us at bmbd@wealthdesigngroup.net. And don't forget, while I'm giving all of our information, like us on our Facebook page, Big Money Big Daddy Facebook page. We got some cool stuff going on there if you like us. And we talk about all of our upcoming coaching events. But this, it's almost full. So if you're listening to this right now, you need to call right now, 713-826-0426, and we'll get you a spot. But it's going to be fantastic information. So yeah, you need to save 20% of your gross income. Young professionals, you've got some of that's obviously going to go towards paying down debt, but that's good advice for everybody. I also, one of the things that we talk about to young professionals is, yes, you want to participate in your 401k plan, and yes, there's a match that's there, and you want to make sure that you are partaking in that and getting the free dollars. But we also don't tell young professionals to put everything they have in those retirement plans. Now, I know that goes against common advice, because common advice looks at a spreadsheet and says, yeah, but if I put money in XYZ mutual fund in the 401k, or I put the same amount of money in the same fund outside of the 401k 30 years from now, because of the tax benefits, the 401k is better. Well, yes, but that's 30 years from now. I'm willing to bet there's going to be some things that happen between now and the next 30 years that are unforeseen, such as, what about the great business opportunity, the great real estate deal that you couldn't partake in because all your money was locked up till you were 60 years old? So no one ever thinks about that. You need to build a war chest of money that you have access to for opportunities. And now most financial planners do talk about you should have 3 to 6 months for emergency reserves, and I agree with that. But I'm going to think bigger than that. It's not just emergencies. I want money for opportunities, opportunity reserves. That's sort of how I look at it. And so that's one of the things that we really talk to our young professionals about, because those that build that war chest are the ones that get to take advantage of those opportunities.
Yep. And so understand when you're looking at your 401k what those opportunities are. Know that, know what the difference is between a traditional 401k and a Roth 401k, and how does that impact you based on the amount of income you're making today. Could make sense to do a Roth today. It may not make sense to do a Roth today. But understand what that is, because a lot of times most people are like, oh, I'll just do it the traditional way. Or maybe your CPA told you to do that, but your CPA is trying to save you the most taxes today. They're not thinking about how does that impact you 20, 30 years from now, because
they're going to be retired.
Right. So if you think about it, if you're doing the traditional method, if you're making $100,000 a year and you're putting, 15 grand a year into your 401k, well, you only have to file $85,000 of income on your taxes. So that sounds like a pretty good deal, and you're happy, your CPA's happy because he gave you good advice. But, if tax rates were higher when you got to retirement, that wasn't such a good move, because you could have paid those taxes and been done with them, right, at a lower rate. But you didn't do that. And you in effect, you just deferred the taxes. You think you're getting a tax deduction, but really all you're doing is paying those taxes 20, 30 years down the road. So if you could have paid them at a lower tax rate, that was a greater move. Now, do we know where tax rates are going to be 30 years from now? We don't. But it's good to know what your options are. And sometimes it's just good to have different buckets of money, some taxable, some, tax deferred.
Would you like to pay tax on the seed or the harvest? Which one do you prefer? And of course that's dealing with young professionals. A lot of times we have some of our baby boomers that are kind of preparing for retirement, and they're making great incomes right now, some of the largest incomes that they've ever made, but they didn't save enough money is the reality. But now they're putting it away and trying to build for retirement. But in those instances, it could very well be that they're going to be in a lower tax bracket in retirement. Therefore, the pre-tax might be for them. So it depends on the it really depends on the individual circumstances. We also one of the things I don't think we mentioned is just a lot of our young professionals, they don't think about getting a will, at least writing something out. Real basic, easy stuff to do. They just don't do it. Of course, that's
especially if you're married.
Well, right. Especially if you're married.
More
if you're not
important
married,
there,
not that big of a
lot of times
deal.
you're like, I'm single, I don't need a will.
Yeah, and you're going to live forever when you're young.
Yeah.
Oh, that's awesome. And on that note, that brings us to our bop, bang, boom, hard truth minute that only a good Big Daddy would tell you. Do you actually know when you're going to be debt-free? Well, if not, you need a better financial plan. Or maybe you just need a plan. In fact, do you even know the answers to these questions? What type of mortgage is the best? Are there government debt forgiveness programs that are available to you? Do you know how to pick the funds in your 401k? Are you understanding how to maximize cash flow not only today, but also what will happen in retirement? Are you on track to meet your financial independent and retirement goals? And is your estate in good order? If not, you need to hire a financial advisor.
Fantastic. So we covered a lot today for the young professional. And if you're not a young professional, hopefully you also took some value out of today's show. And hopefully you can share this information with someone that love and care about. Hopefully, whether you've got kids or grandkids or whatever it may be, let them know that we are here to help, and we will be willing to take a look at what they've got going on in life and let them know. And, a lot of times you just feel like I'm young and I don't need a plan, or I'm not in a position, and I'll deal with it when I'm ready. But there's no better time to begin to put together a financial plan than right now, no matter where you're at in your career, even if you're just starting out.
If you're interested in taking just a look of an example financial plan, just give us a call. We'll set up a time to do a webinar or a meeting. 713-826-0426. That's 713-826-0426. I think that's a great way to start. Maybe you've got an investment portfolio. You want us to do an analysis of it. You got money in a 401k. That's something we can also do. Again, just give us a call, and we're happy to take care of those things. And then really the last item is, you want to meet our firm, you want to meet investors, you want to get a better understanding for what we believe in and how we operate. Come to our October 20th coaching session at Papado's at 6:30 in the evening as your money manager associopath. We're going to be talking about ways that you can make sure your money's not being mismanaged or, frankly, stolen. So please come to that if you want to. Text the keyword DADDY to 72727. Text DADDY to 72727.
Big money, big daddy.
I've had enough of screaming and messing around with jerks. My car is parked outside, I'm afraid it doesn't work. I'm looking for a partner, someone who gets things fixed. Ask yourself this question, do you want to be rich? I've got the brains, you've got the looks. Let's make lots of money. You've got the brawn, I've got the brain. Let's make lots of money. You got the brawn, you got the brain.
Hypothetical examples discussed are not intended to suggest a course of action or represent the performance of any product or security. All investments contain risk and may lose value. Past performance is not a guarantee of future results. Diversification does not guarantee profit or protect against market loss. Investing in foreign securities may involve heightened risk, including currency fluctuations, less liquid trading markets, greater price volatility, political and economic instability, less publicly available information, and changes in tax or currency laws. Such risk may be enhanced in the emerging markets. The S&P 500 index is generally considered representative of the stock market as a whole. It, however, focuses on the large cap segment of the U.S. market. Indexes are unmanaged and you cannot invest directly in an index. Wealth Design Group does not give tax or legal advice. Anything mentioned in the show related to these items is not advice, and you must check with your CPA or attorney prior to taking action. Securities, products, and advisory services offered through Park Avenue Securities, a member of FINRA SIPC.